Have you ever looked at a trading chart online and felt completely confused? Candles moving up and down, lines everywhere, and you have no idea what any of it actually means. It feels complicated, like something only professional traders can understand. But what if I told you that by the end of this video, you'll be able to read a chart as easily as you read your native language? You'll move from looking at a chart like this and feeling completely lost to looking at a chart like this and immediately understanding what the market is doing. And this video is the first lesson of a complete free trading course on this channel. In this video, you'll learn how to instantly tell who is controlling the market, buyers or sellers, how to read candlesticks like a language instead of guessing, the hidden psychology behind powerful candlestick patterns, how to spot when the market is about to reverse before it happens, the one thing most traders ignore that makes patterns actually work. By the end of this video, you won't look at charts the same way again, and in the next lessons, we'll build on this step by step until you can analyze the market like a professional trader. Before we get started, if you want more videos like this, make sure to like, subscribe to the channel, and hit the notification bell so you don't miss any new uploads. Now let's begin. Let's start with the first and most important skill every trader must learn: Japanese candlesticks. The first thing you need to understand when looking at a chart is the candlestick. A candlestick is simply a visual way to show how price moved during a specific period of time. Depending on the chart you are using, that period could be 1 minute, 1 hour, or even 1 day. Each candlestick gives you 4 important pieces of information: the opening price, the closing price, the highest price, the lowest price. The thick rectangular part of the candle is called the body. It shows the distance between the opening price and the closing price. Above and below the body, you will often see thin lines. These lines are called wicks, or sometimes shadows, and they show how far the price moved above or below the body during that period. The color of the candle tells us who was in control of the market. If the candle closes higher than it opened, it is usually shown in green, which means buyers pushed the price upward. If the candle closes lower than it opened, it appears red, which means sellers pushed the price downward. So every single candlestick represents a small battle between buyers and sellers. It shows us where the fight started, how far price moved, and who was in control when the candle closed. Now, let's apply this knowledge with a simple exercise. Look at this chart example. As you can see, we have 4 green candles. Let's read them one by one. The first candle opened here and closed higher here. This tells us that buyers were in control of the market during this period. The second candle opened here and again closed higher. This means buyers continued pushing the price upward during this period. The third candle opened here and closed higher. Then we have the fourth candle. Price opened here and closed even higher. Once again, this shows that buyers were still in control of the market during that period of time. So just by looking at the opening price and the closing price, you can already understand something very important. You can see that buyers are dominating the market, which means the market is bullish. And this information is extremely important. Later in the video, you'll understand why it matters so much when making trading decisions. So even with this very simple observation, just looking at where the candle opens and where it closes, you can already identify who is controlling the market. And when you start looking at many candlesticks together, they begin to form patterns. These patterns reveal how buyers and sellers are behaving, and they often give us valuable clues about what the market might do next. Now let's look at an example of how multiple candles together can form a pattern. Look at this candlestick pattern. The first candle opens here and closes higher. This tells us that buyers were in control of the market during that period. But then something interesting happens. The second candle opens above the closing price of the first candle, which at first suggests that buyers might continue pushing the market upward. However, instead of continuing higher, the price suddenly moves down and closes below the opening price of the first candle. This means that sellers completely took control of the market during that session. In other words, sellers did not just push the price down slightly, they completely erased the move created by buyers in the previous candle. This type of pattern is called the engulfing pattern, also known in Japanese trading as tsutsumi. The word tsutsumi means to wrap or engulf, because the second candle completely covers the previous one. When the second candle absorbs the first candle like this, it often signals a shift in power between buyers and sellers. Japanese rice trader Munehisa Homa, who developed candlestick analysis, described this situation in a very powerful way. When one day swallows another, the market's heart has changed. In other words, the side that was losing the battle has suddenly taken full control of the market. There are two main types of engulfing patterns. If the first candle is bullish and the second candle is bearish and completely engulfs it, this is called a bearish engulfing pattern. It suggests that sellers have taken control and the market may start moving downward. On the other hand, if the first candle is bearish and the second candle is bullish and engulfs it, this is called a bullish engulfing pattern. This suggests that buyers have taken control and the market may begin moving upward. Now let's use this knowledge and try to analyze a real chart. Look at this example. As you can see, we have multiple green candles forming one after another. As we explained earlier, when a candle closes above its opening price, it means buyers were in control during that trading session. So the first candle shows buyers pushing the market upward. The next candle shows the same thing. Then the next one again. Session after session, buyers continue to dominate the market. When we see many candles moving in the same direction like this, we call it a trend. In this case, it is an uptrend, which means buyers are controlling the market. But then something interesting happens here. Look at these two candles. The first candle is bullish, meaning it opened lower and closed higher. But the second candle opens above the closing price of the first candle, and then suddenly moves down and closes below the opening price of the first candle. When this happens, the second candle completely engulfs the previous one. This forms what we call a bearish engulfing pattern. What does this tell us? It tells us that buyers were previously in control of the market, but now sellers have taken control. And when this kind of shift happens after a strong upward move, it can signal that the uptrend may be ending and a new downtrend could begin. So, as you can see, even with this small amount of knowledge, you can already start understanding where the market might move next. But this is still not enough to become a complete chart analyst. That's why you should stay until the end of this video, because what you're about to learn next will completely change the way you analyze the market. Now let's look at the opposite scenario. Here we see multiple red candles, which tells us that sellers are in control of the market, creating a downtrend. But then we see the formation of a bullish engulfing pattern. This pattern shows that buyers have stepped in strongly and completely absorbed the previous bearish candle, and this often signals a possible reversal, where the market may start moving upward instead of downward. Now let's move to another important candlestick pattern called the harami. The word harami comes from Japanese, and it means pregnant. It has this name because the pattern looks like a small candle inside a larger candle, just like a baby inside the mother's body. The harami pattern is made of two candles. The first candle is usually a large candle, showing strong movement in one direction. The second candle is much smaller, and it forms completely inside the body of the first candle. This change in size is very important because it tells us that the momentum of the market is slowing down. In other words, the side that was previously controlling the market is starting to lose strength. And during that specific period of time, the market is no longer moving strongly in one direction. Instead, it begins to enter a state of pause, or what we can call a small range. That is why, when we spot a harami pattern, we can draw a line above the highest point of the mother candle and a line below the lowest point of the mother candle. These two lines give us the range boundaries of that specific period, and this is very useful because it helps us understand what the market may do next. As we said, the harami pattern indicates equilibrium. It shows that the market is pausing, and neither buyers nor sellers are clearly in control at that moment. But this pause does not last forever. If the market later breaks above the range of the harami, this tells us that buyers have taken control again, and the market may continue moving upward. On the other hand, if a new candle forms and breaks below the lower boundary of the harami range, this tells us that sellers have taken control and the market may start moving downward. So the harami does not only show us that the market is pausing, it also gives us a clear framework to understand where the next move may begin. Now let me show you a real chart example. As you can see here, we have 4 green candles, and as you already know, green candles tell us that buyers are in control of the market. Then a harami pattern forms. This tells us that buyers are no longer pushing the market with the same strength. They were driving the market higher, but now the market is pausing and we need to wait and see what it decides to do next. Now look at what happens. Another candle forms and breaks above the harami range. This indicates that buyers have taken control again, and the market is likely to continue moving upward. So as you can see, by understanding the psychology behind the harami pattern, you can already begin to anticipate what may happen next. Now look at another example. Here we have multiple red candles forming. This tells us that sellers are in control of the market. Then a harami pattern appears. This indicates that the market enters a range during that specific session. For example, if you are using the 15-minute chart, you could say, the market was trending downward, but during the last 30 minutes, it entered a pause, and now it is ranging. At this point, we do not yet know what the market will do next, but then something important happens. Another candle forms and breaks below the harami range. This tells us that the market is not changing direction. After a pause, it may now continue moving downward. So once again, the harami pattern helps us understand when momentum is fading, when the market is entering equilibrium, and when a new move is starting. As you can see, even with this small amount of knowledge, you are already starting to read a chart like a language. But this is still not enough. You still need more concepts to fully understand how the market works. And that is exactly what I will teach you in this video, step by step. So stay with me until the end. Now let's move to the next candlestick pattern, called the morning star. The morning star is a 3-candlestick pattern that often signals a bullish reversal in the market. In simple terms, it shows us that control of the market is shifting from sellers to buyers. Let's break it down step by step. The first candle is a long bearish candle. This candle shows strong selling pressure, meaning sellers are clearly in control of the market. The second candle is much smaller. It can be bearish or bullish, but what matters is that it reflects indecision in the market. After strong selling pressure, the market suddenly slows down. This candle tells us that sellers are no longer pushing the market with the same strength. Then comes the third candle. This is a strong bullish candle that closes well above the midpoint of the first candle. This shows that buyers have stepped into the market and taken control from sellers. So when we read this pattern, the story becomes very clear. The first candle shows seller power. The second candle shows indecision. The third candle shows buyer strength. And this shift in control often signals that a bullish reversal may be starting. Now let's look at a chart example. As you can see here, we have multiple red candles in a row. As we explained earlier, red candles mean sellers are in control. So the market is clearly trending downward. But then the morning star pattern forms. This pattern tells us that sellers are no longer dominating the market. Instead, buyers have stepped in and taken control, which means a reversal may be about to happen. Now let's look at the opposite version of this pattern, called the evening star. The evening star is also a 3-candlestick pattern, but this time it signals a bearish reversal. The first candle is a strong bullish candle, showing that buyers are controlling the market. The second candle is again small, reflecting indecision in the market. The upward momentum begins to slow down. Then comes the third candle, which is a strong bearish candle that closes well below the midpoint of the first candle. This tells us that sellers have entered the market and taken control from buyers. So once again, the story becomes very clear. The first candle shows buyer strength. The second candle shows indecision, the third candle shows seller power, and this shift in control often signals that the market may begin moving downward. Now let's move on to the next candlestick, the tonkachi. The word tonkachi comes from Japanese, and it means hammer. This pattern gets its name because the candle looks like a hammer, with a small body at the top and a long lower shadow. This candlestick represents a conflict between buyers and sellers during a specific trading session. At the beginning of the session, sellers push the market downward. They manage to move the price lower and appear to be in control of the market. But then something important happens. Buyers step in and begin to resist those lower prices. They push the market back upward, rejecting the move created by sellers. By the end of the trading session, the candle closes near the top, leaving behind a long lower shadow. This final shape tells us something very important. Even though sellers were strong at the beginning, buyers eventually won the battle during that session. Because of this shift in control, the tonkachi is often considered a potential reversal pattern. Now look at this chart example. Here we can see that the market is clearly trending down, which means sellers are dominating. But then a tonkachi candle forms. This candle shows that sellers tried to push the market lower again, but buyers strongly rejected those prices and pushed the market back up. This rejection of lower prices indicates buyer resistance first and then buyer dominance. And when this happens after a strong downward move, it often signals that the market may be preparing for a reversal. Now let's look at the opposite version of the tonkachi, called nagaraboshi. The word nagaraboshi comes from Japanese, and it means falling star or shooting star. This candlestick has the opposite shape of the tonkachi. It has a small body at the bottom and a long upper shadow. Just like the Tonkachi, this candle represents a battle between buyers and sellers during a trading session. At the beginning of the session, buyers push the market strongly upward. They manage to drive the price higher and appear to be in control of the market. But then something important happens. Sellers step in and begin to resist those higher prices. They push the market back downward, rejecting the upward move created by buyers. By the end of the trading session, the candle closes near the bottom, leaving behind a long upper shadow. This tells us something very important about market psychology. Even though buyers were strong at the beginning, sellers eventually took control of the market during that session. Because of this shift in control, the Nagaraboshi is often considered a bearish reversal pattern. Now look at this chart example. Here we can see multiple green candles, which tells us that buyers are dominating the market and pushing the price upward. But then a Nagaraboshi candle forms. This candle shows that buyers tried to push the market higher again, but sellers strongly rejected those higher prices and pushed the market back down. This rejection of higher prices indicates seller resistance first and then seller dominance. And when this happens after a strong upward move, it often signals that the market may be preparing for a downward reversal. Now let's move to another powerful candlestick setup that combines the harami with the Tonkachi and the Nagaraboshi. This pattern is called the fakie setup. The fakie setup starts with a harami structure. First, we have a large candle, which we call the mother candle. Then we have a smaller candle that forms inside the body of the mother candle. This small candle is often called the baby candle. When this structure appears, the market usually enters a short period of pause or indecision. At this point, we draw two important lines, one above the high of the mother candle, and one below the low of the mother candle. These two lines define the range of the harami pattern. Now something interesting happens. Sometimes the market breaks outside this range, which normally suggests that the market will continue in the direction of the breakout. But in a fakie setup, the breakout fails. For example, imagine the market breaks below the harami range. At first, it looks like a continuation to the downside. You might even say, Chris from Pro Trading School told us that if the market breaks below the harami range, sellers are taking control. But then something unexpected happens. Before the candle closes, the price moves back up and closes inside the harami range again. This is what we call a false breakout. And when this false breakout happens with a Tonkachi shape, it forms what we call a bullish fakie setup. This pattern tells us that sellers were trapped. They thought the market would continue downward, but instead, the market rejected the breakout and moved back inside the range. This trap often signals that buyers are about to take control of the market, leading to a potential bullish reversal. Now let's look at a chart example. As you can see here, we first have multiple red candles, which indicates a downtrend. This tells us that sellers are controlling the market. Then a harami pattern forms. The small baby candle appears completely inside the mother candle, which tells us that the market has entered a short period of pause or indecision. Now watch what happens next. The next candle remains within the harami range, and the following candle breaks below it. At first, this looks like a continuation signal, suggesting that the market will continue moving downward. But before the candle closes, something important happens. The price moves back up and closes inside the harami range again. This is a clear false breakout, and this is exactly what defines a fakie setup. It tells us that buyers have trapped sellers in a false breakout. And when traders get trapped like this, the market often moves strongly in the opposite direction. So after this trap, the market is likely to move upward. Now let's look at the opposite version of the bullish fakie setup, called the bearish fakie setup. This pattern is a combination of a harami structure followed by a Nagaraboshi candlestick. Just like before, the setup begins with a harami pattern where a small candle forms inside the body of the mother candle. This tells us that the market has entered a phase of indecision or equilibrium. At this point, we draw two important levels, one above the high of the mother candle and one below the low of the mother candle. These two lines define the range of the harami pattern. Now something interesting happens. A new candle forms and breaks above the upper boundary of the harami range. At first, this looks like a continuation signal, suggesting that the market may continue moving upward. But before the trading session ends, the candle moves back down and closes inside the harami range again. This is what we call a false breakout. And when this false breakout forms with a Nagaraboshi shape, it creates a bearish fakie setup, which is a bearish reversal pattern. Now look at this chart example. As you can see, we first have multiple green candles, which indicates that buyers are in control of the market, creating an uptrend. But then a bearish fakey setup forms. This pattern tells us that buyers were trapped by sellers in a false breakout. And when traders get trapped like this, the market often moves strongly in the opposite direction. In this case, it suggests that the market is likely to reverse and move downward. Now let's move to the next candlestick pattern called the doji. A doji is a candlestick that forms when the opening price and the closing price are almost the same. Because of this, the candle usually looks like a small cross or a plus sign on the chart. This happens because during that trading session, buyers and sellers push the market in both directions, but by the end of the session, neither side is able to gain clear control. So the doji represents a moment of balance or indecision between buyers and sellers. But the meaning of a doji depends heavily on where it appears on the chart. For example, if the market is trending upward and a doji appears, it often indicates that the market is pausing or hesitating. In this situation, the doji shows that buyers are losing momentum for a moment, but the market has not necessarily changed direction. If the price later breaks above the high of the doji, this often signals a continuation of the uptrend. The same idea applies in a downtrend. If the market is moving downward and a doji appears, it also signals a pause or hesitation in the market. But if the next candles break below the low of the doji, this often indicates that the downtrend may continue. However, the doji can also signal a potential reversal depending on where it appears. If a doji forms at the end of a strong uptrend, it can indicate that buyers are losing strength and that sellers may soon take control of the market. And if a doji forms at the end of a strong downtrend, it can signal that selling pressure is weakening and that buyers may soon step in to push the market upward. So the doji is an important candlestick because it shows us a moment when the market stops and hesitates, and this hesitation often gives us important clues about what the market might do next. Now that you've learned the key candlestick patterns, let's test your understanding with a quick exercise. Look at this chart. The market is clearly trending up, which means buyers are in control, but then this candlestick forms. What do we call it? I'll give you 5 seconds to think about it. This is a bearish engulfing candle. Now think about what it represents. It shows that sellers have stepped in and completely overwhelmed buyers. A moment ago, buyers were in control, but now they've been engulfed. So what do you expect next? Will the market continue going up or reverse? Take a few seconds. The answer is simple. A bearish engulfing is a reversal signal. It tells you that buyer momentum is fading and sellers are taking control. And look at what happened next. The market dropped. Now look at this chart. As you can see, the market was trending up. It reached this level, pulled back slightly, and then a bearish engulfing candle formed. At first glance, this looks like a perfect reversal signal, so you might think, that's it. This is a bearish setup, the market should drop. But look at what actually happened. The market went up again. Then, later on, another bearish engulfing candle formed, and this time, the market dropped. So now the question is, why did the first one fail, and the second one work? The answer is simple. When the market reached this level and reversed, it created a reference point, what we call a resistance level. Now, pay attention to what happens next. When price comes back to this level, it gets rejected and forms a bearish engulfing candle right at that resistance. And that's the key. The location of the pattern is what gives it power. A bearish engulfing in the middle of nowhere. Low probability. A bearish engulfing at a key resistance level. High probability. So what does this tell you? Candlestick patterns alone are not enough. Yes, they help you read the market, but on their own, they cannot reliably predict future price movements. To trade effectively, you need confluence. You need to combine candlestick patterns with key tools like support and resistance. And that's exactly what you'll learn in the next lessons of this course. If you enjoyed this video, make sure to hit the like button, subscribe to the channel, and turn on notifications so you don't miss the next lessons in this free course. Thank you for watching, and I'll see you in the next lesson.